Had a trio of positive reports, of course, the ISM, the NAR report on existing home sales and construction. For all those dollar bears out there who say that the dollar is dying a secular death, remember Mark Bobber last week said it's going to go to zero, but it'll take 10 years. Our next guest says, hold your horses for a second. The dollar's due for recovery. Joining us over in the USA is Brian Dolan, Chief Currency Strategist at Gain Capital Group. Brian, good evening to you. What's going to save the dollar? I mean, deficits are mounting. America is on steroidal stimulus. There's got to be nothing going for the USD.
Good morning, Bernie. Well, the big thing that's going for the dollar is basically what I believe is going to be the end of a serious pullback in the overall risk rally. So we've had a very nice move up in stocks and commodities and a consequent move down in the dollar. As we look at the earnings that are coming through from the various corporations, Ford's a prime example. What we're starting to see is basically there's no organic growth to the earnings. There's nothing behind this overall rally. With that and the fact that valuations are overextended, we're trading at above a 20 price to earnings multiples. This is not sustainable, and looking at the overall economic outlook, with unemployment high and still rising, consumers still deleveraging, there's very little reason to expect that the profitability forecasts in the months ahead are going to be met. So ultimately what we're looking at there is a pullback in the risk rally, and that's going to see the dollar spring back. And the other catalyst there is we've got a massive short dollar trade out there. Everybody and their brother, as you mentioned, is short the dollar and says it can only go one way, and that's south. My experience is there is no such thing as a free lunch in the market. So there's right now the market's been having a free trade with selling the dollar and it's constantly going down. But that is about to turn around, and I'm looking for a dollar rebound into the end of the year.
But, well, the drag on the U.S. dollar, obviously, is the fact that the Fed really has no wiggle room to move on rates at a time when you've got others. You've got the Indians, you've got the Australians tightening and just creating a real yield advantage that just continues and continuing to knock on the dollar. In a zero rate or essentially a frozen kind of a rate environment, how are you going to get to where you say we're going to, how are we going to get there?
Right. I'm not saying that we're going to see a massive surge in U.S. dollar strength. What we are is going to have a nice, healthy 5 to 10% correction higher for the dollar. You're entirely correct. The Fed is not going to be raising rates anytime before the end of 2010, and even that's a question mark. But then you're also looking at some negatives against other currencies, in particular the British pound, and then a number of key governments basically voicing concern over the strength of their own currency and the weakness of the dollar. So that, I think, puts a floor under the dollar, and you're going to very likely, if it should weaken further, I would expect to see concerted G20 intervention.
What is the, wait a minute, concerted G20 intervention? We haven't seen that for 6 years, have we? They don't have the money to do that anymore, especially in concert.
They have more. The reserves keep accumulating, and they have the biggest war chest on record. So if they wanted to, they certainly have the firepower to make it extremely dangerous for dollar shorts to keep plugging away.
Well, they're already doing that, though. I mean, individual countries, individual administrations are doing that. But it's not having any effect individually. You got to get together. You got to get a band of brothers together to get any real knock-on and real impact.
That's correct. Individual central bank intervention generally doesn't have immediate success. Concerted intervention, though, has a great long-term track record. If you take a look back, it's signified the highs and lows and major currency turning points over the last 2 decades. So I think concerted intervention is there. Obviously, there is consensus within the G20. The hang-up is the U.S. Treasury. They are not. They seem to be quietly enjoying dollar weakness for what it does for the export sector and underpinning some economic growth. But it's clearly reached a tipping point where the Europeans are going to press very hard at the G20 meeting in Scotland this week for the dollar to really put some teeth into the strong dollar and basically end the laissez-faire attitude toward dollar weakness.
What other tricks in the arsenal do they have that have not been discussed that perhaps have been rusting away in the sort of old classic war chest there? Maybe about sterilization versus non-sterilization, maybe scrubbing the markets with other than the usual tools like reserve requirements, open market operations, and direct movement on interest rates. Is there something else out there, sort of a second tier ammunition?
I think one of the coming events is going to be the Fed signifying that they're not going to be expanding any further their asset purchase plan. Ultimately, that will take the lid off of U.S. rates, and we'll start to see a little bit of a market appreciation in U.S. yields. That'll provide a little bit of support for the dollar, but ultimately it's going to come down to the positioning and a vote of confidence coming from the G20 that the dollar is weakened sufficiently.
Okay, Brian, it certainly looks like parity for the AE dollar and the loon with the U.S. dollar off the cards for now. Appreciate your time, okay? We'll talk this through. I'm sure things will change on a dime within a week or two.